So, Citigroup just dropped its latest earning reports, and on the surface, it's a showstopper. We are talking their best quarterly revenue in a decade. Net income soaring by a whopping 45%, and four out of their five businesses are seeing double digit growth. Sounds incredible, right? But here is the kicker, the one number that truly tells you what this bank is worth. It did not budge, not one bit. You heard that right. Profits exploded, but the metric that actually prices the stock flat. And the story behind that disconnect, that's what we are diving into today. I'm Vikas, your host, and this is what changed from Wing. We don't just chase headlines, we break down what really changed. Let's get straight to its headline scorecard. The big news everyone's buzzing about, net income up 45%. Citi's best revenue quarter in 10 years. But the reality is their return on tangible common equity or ROTCE was 13.0%, just a hair below last quarter's 13.1. This was a genuine quarter and operationally it was strong. They grew their profit without actually improving their core return. The number looked great, but the underlying trend, it hit a pause. I'm going to give you the key to unlock this entire episode right now because once you get this, everything else will just click. Imagine if a student last semester, one though class really tanked their GPA. Let's say they pulled a D this semester, they buckle down and that D skyrockets to an A minus. Huge win, right? On papers, but it's a massive improvement. But then you look at their overall GPA, that single number that truly reflects their academic standing across all their classes, and it's basically the same. The jump in that one class was real, but it did not mean they suddenly got smarter overall. That, my friends, is Citigroup this quarter. Keep that analogy in mind. Let's start with the headline everyone's quoting, net income up 45%, revenue jumped 14% to about $24.8 billion, their best in a decade. From a distance, it looks like a total blowout. But here at Wing, we always dig deeper. We walk you from the loudest numbers to the truest ones. So here is the first layer of truth. What exactly is that 45% measured against? Well, a year ago, Q2 of 2025 was a pretty weak quarter for Citi. They had to set aside a big chunk of change, about around $638 million dollars for potential future loan losses. This quarter, that number was only 118 million. So, a significant part of that 45% is not about the business suddenly becoming a powerhouse. It's because if we comparing to really low bar from last year, that sounds perfect. So it's like that students D to A minus jump in one class. It's real on papers, but it's more about recovery than raw horsepower. Now, let's discuss about the second layer. Where did this growth actually come from? And this is where it gets fascinating because a lot of it came from the two most cyclical parts of the bank. Their markets revenue shot up 17%, and banking, that's their investment banking arm, so a 44% increase, with net income up an astounding 276%. That last number sounds like a game changer. Yes, it is 276%, a structural breakthrough. But It is not. It's a boom in deal making. Companies rushing to issue stock and debut during a hot market window. Equity issuance up 92%, debt issuance up 65%. These are the numbers that light up when markets are budging, and they go quiet the moment the window closes. And in this earning cycle, this is happening with each and every major banks. Everyone is earning huge profit from their deal making business. Now you can't bank on a peak deal quarter repeating every single quarter. Now the third layer, the trust one, the GPA, return on tangible common equity. This is just a fancy way of asking for every dollar of shareholder money the bank uses. How many cents of profit does it actually earn? It's the number that truly dictates whether a bank's value goes up or down. So this quarter it was 13.0%. Last quarter 13.1. It essentially went sideways, a tiny dip even. So profits up 45%, but the return per dollar of capital flat. How is that possible? Because while profit grew, the pile of capital it's earning on grew right alongside it. And as we mentioned, that year ago comparisons was soft. The grade jumped, but the GPA did not. Now, why this matters? Let's just discuss this gap, this difference between profit growth and flat returns is absolutely critical for Citi. And here is why. For years, Citigroup's entire investment in narrative has been built on one promise: we will get our returns up. CEO Jane Fraser has staked the bank's turnaround on a clear target, hitting 10 to 11% ROTCE this year and even higher after that. So, for this stock, the question is not just did profit grow, it is the return still climbing? And the honest answer from this quarter is they cleared the target. 13% is comfortably above 10 to 11, but the climb itself paused. That's the crucial delta, not just the level, but the trajectory. Now, to be fair to City and here at Wing, we always give credit where it's due. There is a genuinely fantastic business hiding beneath all those flashy headlines, and almost no one is talking about it. It's called services. Think of it as the essential plumbing of global corporate finance, moving cash across borders, safeguarding assets, holding funds. This quarter, services hit its highest revenue ever, and it did so at an impressive 30.9% return. That, my friends, is an exceptional, durable, and in the best possible way, boring business. If any part of City deserves a re-rating, it's this one. But it got overshadowed by the more attention-grabbing deal-making numbers. Here is another counterintuitive finding, one that might make your brain do a double take. Look at their consumer credit card business. Its revenue grew by just 1%, the weakest of all five segments. Read that in isolation, and you might think the US consumer is flattering. But dig a little deeper. Card spending is up 11%. New card signups are up 65%, and credit quality is actually improving. The business is getting stronger. That 1% revenue figure, it's because Citi is deliberately investing heavily right now to build out that card portfolio, costs that hit today for accounts that will pay off big later. So this point you need to remember that they are building a big portfolio for the cards, and this will pay off them in a big way later on. So the segment that looks the weakest is actually a healthy business the bank is strategically making look worse in the short term. It's the exact opposite of what the headline number suggests. And one bias we need to call out because this quarter is a classic trap. Recency bias when you see investment banking revenue up 276%. Every instinct screams extrapolate. This is the new normal. Don't. Peak deal quarters are cyclical. They don't repeat on command. Mistaking a cyclical high for a permanent run rate is the classic late cycle error. The truly durable story here is services. The cyclical story is banking. Don't get them confused. So, where does all this leave us? Last quarter, Citigroup scored a 6.8 out of 10 on our conviction scale. Today, that moves up slightly to a 7.1 out of 10. It goes up, not down, because the business is genuinely broad and that durable core is services is very real. But it only moves a little because the central promise this whole story hinges on the return climbing, not just clearing the bar post this quarter. This isn't a buy recommendation or sell recommendation. It's simply our assessment of how much confidence today's evidence truly deserves. So, three crucial questions for the next quarter we'll answer. Does the return start climbing again? 13% cleared the target, but it went sideways. The next quarter has to show that climbing resuming. Otherwise, that 45% profit jump starts to look like a peak, not a new base. Second, do the cyclical engines hold up? Markets and banking were the big drivers this quarter. Keep a close eye on whether that deal making revenue stays strong or if it starts to fade as the market window potentially closes. And the third one, does the consumer investment pay off? Citi is spending big to build its card book right now. The real indicator will be whether card revenue reaccelerates as those new accounts mature and start generating returns. The real story today is not just a 45% profit jump, it's a strong, broad quarter from a bank whose core return stood still and now has to prove that the climb is back on. If you want to dive deep into every chart, every source, and every calculation behind today's analysis, you will find the complete research report at vyng.io. Everything is sourced directly from Citigroup's official filing because trust is not built by confidence, it's built by transparency. I'm Vikas. This has been What Changed from Wing, clarity, not clutter.